Vandana Hari, founder of Vanda Insights and today's guest host. It's my pleasure to welcome today's guests, Robin Mills, Chief Executive Officer of Kamar Energy, Mike McGlone, Senior Commodity Strategist, Bloomberg Intelligence, and we are hoping to be joined by Rafiq Latta, Senior Correspondent at Energy Intelligence. So the week has started off with all the promises of another roller coaster ride in crude prices. We saw a 5% jump in Brent and WTI futures at yesterday's settle. Prices are trading slightly weaker in Asia as we speak. The major factors on the horizon, of course, the Fed rate hike, Europe's energy crisis just appears to be going from bad to worse every minute. Force majeure on the Keystone pipeline that delivers crude from Canada to the US, and Russia's Gazprom also evoking the force majeure clause on its gas deliveries to Europe. Meanwhile, just another regular day in China. Unfortunately, COVID cases continue to surge, as do lockdowns and restrictions. Latest tally by Nomura has about 264 million residents in the country under some form of lockdown or COVID restrictions. So certainly not looking good as far as Chinese economy and oil demand goes. Mike, if I may start with you. So we have, within the environment of recessionary fears, we have seen panicky sell-off in risk assets and followed by modest rebounds, some dip buying happening. Most of the action does seem to be concentrated during the US trading hours. At least that's what I've noticed. The latest swing in the pendulum last week was the market began to price in a 100 basis point rate hike by the Fed at its policy meeting later this month. And then towards the end of the week, I think investors took some cheer from officials of the central bank signaling that they will most likely stick to a 75 basis point hike. A two-pronged question for you, Mike. First of all, do you think that oil is now basically tied at the hip with Fed rate hikes and speculation? The second question I will reserve after I hear your first answer.
The answer is yes. The Fed's taken out a sledgehammer on markets, and I'm quite impressed that they're going to go 75 basis points 2 meetings in a row. If you look at the last meeting, copper's dropped about 20%, crude oil's dropped about 20%, the Bloomberg Commodity Index dropped about 10%. Yet the stock market's still unchanged, and that's a problem. If the stock market was down 20%, they would not be hiking another 25 basis points, and that seems to be the target. So I fully expect virtually all risk assets, with the exception of bonds, to continue to decline, and potentially by the time we talk about the next meeting, to be down another 20%. Crude oil is the most vulnerable, virtually all commodities. So let's look at copper was up. Bloomberg Industrial Metals Index was up 40% in the year. Now it's down 15% in the year. Copper's down 25% on the year. Even corn, that super elastic commodity that's got a major reason to rally because of the major issues with supply from Ukraine, is actually almost unchanged on the year. It's that supply demand elasticity factor that always affects commodities, I think, is kicking in. And to me, this is the beginning of the great reversion of 2022, and it's just getting started.
Okay, so then the second question is, if we do see inflation coming off, as exactly as you mentioned, so many commodities have begun to tumble. Dr. Copper has been in bear market for the past several weeks. What do you make of the argument that perhaps the Fed will not need to go on for too long with its very aggressive tightening, and or it may have to even flip very soon to go back to quantitative easing?
Well, that's the thing. It will have to, but it can't, because this is we've come to that point in history. The last 40 years of the Fed put is now they're selling calls against the market. So I fully expect a year from now, when we have this conversation, it's going to be about pretty severe deflation, That was the case before pandemic, before we pumped the most liquidity ever in the system. We pumped M2 money supply to the highest ever. Now, as you mentioned earlier, the pendulum is swinging back, but it's going to swing back like it always has in history. When you run assets too high, they come back down too much, and we're going to go back to the pre-existing trend. So the key thing we have to ask ourselves in terms of crude oils, why is the first time it reached this price around $100 a barrel was 2008? Why is it still at that same level? Because it's one of the worst performing commodities on the planet now in history of you look at GDP and everything that's been increasing much more. If you want one of the better performing commodities, palladium has been one of them, and gold has been one of the better ones. So I fully expect those trends to resume. And this is where we are in history, is that I fully expect the stock market to basically give back all the gains from the COVID rally, which means around 3,200 and S&P 500. We're not too far away from that. Now, if we said that 6 months ago, people thought we were crazy. But Mandana, this is just history in the making. And this is the key thing. The thing about commodities is to say that the pendulum's going to swing back down like it did. The Bloomberg Commodity Index dropped 50% on twice since the peak in 2008. To say that is not profound, but the market doesn't expect it. That is what I fully expected. And you're seeing this happening on a day-to-day basis. Like I said, with the Fed going 75 next week, they are taking out a sledgehammer on markets, and they can't come back out and just ease the minute it drops. It's, gets into a full bear market because of the risks of inflation. We've learned those lessons as humans, the limits of quantitative ease and massive liquidity and inflation, and it's going to be a long time before we go back to where we did for QE.
Yeah. Robin, let me ask you about Saudi Arabia, which seems to be playing its cards close to its vest on production policy. And I think most of us that look at the oil markets closely were not at all surprised by the kingdom not offering Biden anything extra in last week's meetings. But as OPEC Plus cuts come to an end in August, what is your base case for production over, let's say, the last 4 months of this year, as far as OPEC Plus is concerned? And do you see any wild cards at all in terms of their policy?
Well, yeah, very much as expected from Biden's visit. No commitments from the Saudis, as you say, and I think the Saudis, not too much they could have offered. They would have wanted to go back to OPEC Plus anyway and see what the collective decision is, even if they would have a strong input into that, and they wouldn't want to simply be jumping to Biden's tune anyway and immediately giving him something, even if there was a quiet agreement to increase production down the line. So I think we'll only really see if there were any actual results out of that meeting, but from September onwards, and we'll see what Saudi production policy is. But I think the real question is, okay, obviously the OPEC cuts will have rolled off, but by September, only the UAE and Saudi will have any significant spare capacity by that point. So what will they do? Will they just freeze production at that level until the end of the year, which is when the OPEC Plus agreement notionally runs until anyway? Or will they at that point manage to have a realignment and to say production should keep increasing for those who can, at perhaps something like the recent monthly increases? And I think that a key part of that decision will obviously be how the market is looking and where oil prices are and what the demand situation looks like. And if it continues to worsen, then they may feel that there's no need to put more crude in the market. They may stick with whatever they're producing at by September. But also the internal politics, which are very tricky, because obviously you have Russia in there, and we have to see what Russian production and Russian exports are doing with the effect of sanctions. And then we have to look at the other OPEC countries, because if you want to have a completely new OPEC deal, everybody's quotas or targets have to be adjusted. Many of them were set baselines back in 2020 that were kind of nonsense anyway, that they couldn't even produce those baselines, and they certainly can't now. It's become very clear with, we've talked about Angola and Nigeria, for months now, but it's obvious that, most of the OPEC Plus countries can't hit their baselines, with a couple of exceptions. And so, realigning that would be politically very sensitive. Either you give people, again, more kind of nonsense baselines that they're producing well short of, or you give them something realistic, but then there's a real resistance, of course, from people to accept a production level that's lower than they've had previously, even if they can't meet it. So very, very, very tricky. But I think to answer your question on the base case, really very much depends what demand looks like. And I think if demand is reasonably strong and prices are looking okay, Saudi and UAE will continue creeping up until the end of the year. If not, they will just freeze at around current levels, or around, let's say, August levels.
So any chances at all, do you think, of them actually thinking that they need to cut back production some more? Or do you think that'll largely hinge on what the economy is looking like?
Well, that's a possibility. Look, and I think that's again why they haven't wanted to go out alone and make greater production increases and give Biden some more encouragement, because they could see that they may need the OPEC Plus framework again. If there's a significant downturn, there's demand downturn, prices fall sharply, they will want the others to cut. And there's always a question of Russia, because they would want Russia to cut, but maybe Russia doesn't need to, because maybe Russia's producing well below capacity anyway. And Russia's the real big political and market mover in this, along with Saudi. But they would want some support from the others. They'd want some support from Iraq and so on as well, if they have to renew the cuts.
Yeah, absolutely. Mike, I'd like you to help demystify something for me. Is the American public really so gullible that they thought that Joe Biden only needed to make a trip to Saudi Arabia and start mending ties with the kingdom, and he would come back with pledges of 100,000, a few 100,000 barrels of day in production boost?
Well, well, we know the premise of the question. I sure hope not. But the joke we had, I think, last time is Biden should have gone to Texas. The problem is Texas is a Republican state, and it's like we were talking offline. It's very political. But as Robin mentioned, demand destruction is not profound to expect it when you've not only had the highest unleaded gasoline and diesel prices ever in this country, which is nothing compared to Europe, but it's the highest velocity rally on a 100-week average ever. And our data goes back 20, 30 years. And that demand destruction is kicking in. So the latest data from Department of Energy for implied demand is it plunged in July. That never happens. And by never happens, I haven't seen this data that low since 2003, because July is when it spikes and then it plunges in September. And I was one of those people driving last week. I was out in the Midwest driving around, and I can tell you the crops look awesome. And that's just normal. So expecting demand destruction is not profound. The thing is, it's happening at a significant pace. You look at the level of demand of unleaded gas and diesel in this country, it's rolling over. It's not supposed to do that in July, and it is. We're heading towards a 2008-like scenario, and crude oil is actually from a lower level. Why? Because there's too much supply in the big picture. And the total demand from the U.S. is actually lower than it was in 2008. We're running just below 9 million barrels a day. Back then, it was above 9 million barrels. That's what the world's changing, and it's going to follow the U.S. So I look at the macro big picture is, in terms of commodities, is in terms and politicians is if prices don't. Biden needs prices lower to get elected. And if he doesn't, we're just going to go back to the drill at will Republicans, which is happening already. So it's just that pendulum has swung completely. But now it's much more about the macro and the economy in terms of commodities. The key thing I was surprised by since the last 2 months is the stock market's ability to hold up, because that's what the Fed's focused on. It's not that complicated. The Fed needs people to reduce the ability for people to buy stuff. And they're doing it very well. It's just, happens in real time. And I remember 2008, it took for a while, and then finally everything collapsed. And I fully expect, unfortunately, that to happen. And U.S. consumer sentiment is part of it. And you can see it in the demand for unleaded gas. It's rolling over.
Robin, Janet Yellen continues to champion a Russian oil price cap. And, she said that without a cap, the market could potentially lose 3 to 5 million barrels per day of Russian supply, which personally to me sounds quite a pessimistic estimate. But nonetheless, that's what she said. And of course, she was in Asia the last week or so, and it looks like she got a lukewarm response at the G20 and some of the bilateral meetings she had in Asia in terms of getting a buy-in from the Asian governments, and particularly China and India definitely seem to be sitting on the fence on this whole issue of joining a buyer's cartel, as it were. Russia, of course, has been arguing that imposing a price cap will actually lead to crude prices rallying further. So do you see the cap idea getting off the ground at all? And I fully appreciate that this is a difficult question, but based on everything that we have seen so far in terms of the response the US has been getting? Or do you think this idea will just be allowed to die a slow death?
Well, I think the Asian government should welcome the price cap. I think they should say, great, if the Europeans and Americans want to offer a 50% price cap, we'll buy from you Russia at a 40% cap. So I think that shows you why it wouldn't work, because they'll just undermine it. There'll always be an incentive for someone to pay over the cap. And even if you have strict enforcement via insurance, shipping measures, people will just find backdoor ways to pay. They'll pay a bit extra. And we know that from the Oil for Food program in Iraq. And of course, then Putin will start handing out these allocations to his favored friends and playing one person off against another. So no, I think the price cap is, for me, it's a non-starter. Firstly, because I don't think it'll work, and secondly, because I just don't think you can coordinate enough parties, including India and China, to have enough kind of critical mass to make it work. However, what I have said, and I've written about this recently, is I think the way to go, personally, is so the attempt is to square the circle, right? It's to reduce Russia's oil earnings without reducing the amount of Russian oil on the market and therefore boosting prices. If you want to do that, then as I've said and others have suggested, the way to that is a tariff on Russian oil. And you bring in Europe and US and others. If China, India want to join, that's great. They don't have to. It would still work. And you say we're going to tariff Russian oil, let's say $50, $60 a barrel. Russians still get $40. That's enough to cover their production costs, but severely cuts their earnings. And if you have enough buyers joining in, then you get around all these problems. People wanting to cheat because if India doesn't want to impose the tariff, okay, well, they're just taking money out of their own pocket. So there's more of an incentive for people to join this way. So I think that makes a lot more sense. I think it makes a lot more sense for oil as well as for gas. But unfortunately, a few academics have proposed it, but it doesn't seem to get policy traction. I can't understand why, but anyway, the politicians, for whatever reason, have landed on the price cap, which I think, from plenty of past experience, is not going to work.
What do you make of the threat from constantly repeated by Russia that it would slash its production should a cap be imposed? And I presume even if a tariff is imposed, their response, or at least their threat, might remain the same. Do you think it's just a hollow threat, or is that something the world needs to worry about?
Well, I think the Russians are going to respond in some way, whatever measures are taken against them, whether it's a price cap or a tariff or an outright ban or whatever else. They're going to respond, and they've shown this in gas, that they're very willing to cut their production and inflict pain on their buyers, and maybe inflict pain on themselves too. Yeah, short term, because they're thinking short term. They're thinking about getting through the war. They're thinking about getting into winter, putting pressure on Europe, hoping Biden and the Democrats lose in the midterms, and that the political realities force some kind of compromise. I mean, that's clearly the game here. They're not thinking long term about retaining markets and buyer trust and so on, because that's all gone anyway. Yeah. The Russians are very likely they would cut production, but the Russians may well cut production and exports in response to all kind of things, and Europe and the US just needs to be ready for that, whatever measures they take. If they don't take any measures against Russian oil, but they continue to supply Ukraine with weapons, and if Ukraine is fighting effectively, again, the Russians very likely will cut oil and gas supplies, and we're seeing that in gas today. So I don't think that they should certainly think about what Russia's going to do in response, but I don't think they should worry about it or feel constrained. And of course, if there's a tariff on Russian oil, and Russian oil after the tariff is only earning $40 a barrel, let's say, then of course for Russia to cut its production, it'll lose even more, be exporting fewer volumes and again at a lower price. So this again to me is creating a mechanism to ramp up the pressure on the Russians rather than giving in to them.
Yeah, the tariff idea I think has also been around a bit, but as you say, is just not taken off in any way. Let's have the survey question, because my next question for Mike is also quite related to this. It's a bit off the beaten track, today's question, and I'd really appreciate the indulgence of our participants today. So this is based on totally your personal experience, your anecdotal evidence that you have in your own daily life. Do you think consumer spending on goods and services around you is noticeably lower, steady compared with, let's say, the start of 2022, or noticeably higher? And again, I appreciate that none of us is actually measuring any of these on a day-to-day basis. So I just, noticeably is a safe word I thought I'll use. But if you think it's lower, or higher, choose higher option 1 or 3. So that brings me to my next question, Mike. And you did touch upon this, consumer sentiment, consumer spending, and especially when it comes to the US. And of course, we can see what's happening with gasoline consumption. We get pretty transparent, up-to-date, regular data from the EIA, for instance, telling us, what's happening with US gasoline consumption, diesel consumption, and overall fuel consumption. But what, if I may ask you, is the general mood, do you think, in the American public? So, I hear on the one hand, of course, that economists and other market observers write about the considerable savings that people still have. And then there's the pent-up demand, which is still coming, especially for services, travel, leisure activities, and so on. But at the same time, we do hear of consumer confidence starting to go down, just a combination of the fears of recession and all the inflationary pressures. Where would you say is the American consumer spending headed for, just in general, spending and confidence?
Plunging. I had a good sense for that last week. I took a week off. I visited family in the Midwest. I've been on the East Coast for the last 30 years. Most of my family is in the heartland. And the heartland is really what determines what's going on. I have a brother-in-law in the shipping business, clearly turned lower. Says truckers are easy to find now, not too difficult. Last year's a different story, but another brother in the real estate business, he said deals are starting to drop because of the doubling of mortgage rates. Last year, you could get a 30-year mortgage below 3%, 2.5%, and now you're earning 5.5%. It's actual double. So those things. So it's absolute. It's to me, it's rhyming too much like 2008. I remember the price of gas, as we say here, jumped about $4 a gallon, and then everything plunged after that. And after that, I was actually trading back then, did quite well. Now it's $5, and it's doing the exact same thing, but from a much higher plateau. From the equity standpoint, we all know this was an artificial situation. And that money pumping, the writing of checks to citizens was shocking, and it's probably never going to happen again. So it's the hangovers kicking in, and the Fed's taking away the punch bowl. Like I said, it was a sledgehammer. And so my sense is it's rolling over at a higher pace in 2008. I'm showing that in unleaded gas, which to me is the most real-time measure in terms of commodities. And I'll be publishing on it this morning. Again, just updating what I published a few weeks ago, because it's just rolling over. It's not supposed to plunge in the first week of July. This is driving season, and you're not supposed to drop that much, but it is. So it's fully what I expected. To me, this is the great reversion of 2022, and we're in early days.
Okay. Welcome, Rafiq. I am, unfortunately, looks like you weren't able to join us at the start of the show, but I will try and use the remaining minutes on the show that we have with Mike's and Robin's permission to talk a little bit with you. But before we do that, can we just quickly have the survey results? Okay, so 61% say they do see consumer spending noticeably lower. Interesting. Rafiq, unfortunately, I won't have time for all the questions I had for you, but I think let me start with probably the more important one and right at the top of everybody's minds today, the force majeure that Gazprom has declared. Now, I don't know if this was it's a political maneuvering, is it just a threat? Or does it mean that the company is actually getting ready to further reduce gas supplies to Europe, as you know, the biggest fear that has been in Europe for the past several weeks? What do you see as the strategy or the philosophy? What might be the reason behind, or are we reading too much into this force majeure declaration by Gazprom?
I think, you know, show me the man who says, I know 100%, I'll show you a liar. You know, you have to be inside Putin's mind. And I put it to you that that it's a very dynamic set of calculations that he's coming up with here, and things are changing, and he's reacting to circumstances on the ground. But in general, you can clearly see a trend where gas is being used as a political lever and tool in his armory to further this war, this conflict. So it's always a chance that it's driven purely by market circumstances, and this issue, of the turnarounds. But one would have thought that it dovetailed very nicely into his political aims, and he wants to send messages, and he will. I mean, I think he wants to make sure that Europe gets to winter in not a great state in terms of its gas storage, and that prices are very elevated. He really wants to squeeze the pips, and where he's in a difficult place militarily. It hasn't gone as smoothly as you'd have liked, although it's not gone particularly well for the Ukrainians in the last couple of weeks either. So I see this continuing without any breakthrough. I see it messy. I see it very dependent on how things fold out. I don't see it as very predictable at all. And I suspect that it will ratchet up as the pressures on Putin economically and politically ratchet up. And also he sees Ukrainians weakening, and I suspect he's seeing among certain fronts a certain amount of division among his foes, among the Western alliance facing him, and he wants to exploit this.
Yeah, tempers do seem to be rising quite a bit in Europe in terms of the just general public opinion as well, as to where this is all going to take them, where this is going to end, and what kind of a winter lies ahead of them. Do you see any viable relief valves at all for the continent? We know they've been buying really expensive LNG, but and they've been in talks for current suppliers, potential new suppliers of gas pipeline supplies or LNG supplies. Do you see any sort of relief coming from anywhere, at least in time for this winter?
No. I mean, the best thing Europe could do would to be really impose some restrictions now, to slap down hard on consumption, and to cross its fingers and hope for a mild winter. I don't think its supply isn't going to magic up out of nowhere. I don't see, you can squeeze a little bit out of some places, but on the whole, people who can produce gas at these prices are producing it. Who wouldn't?
Exactly. So this kind of
same time, I think long term, Europe's left quite a strong message. Is like, yeah, we want it now, but we're getting off this stuff. So there's not an incentive really for producers to prioritize Europe. It's not like you are helping out a long-term market. I think there's a little bit of change in that we're seeing. We're seeing some noises from the EU Commission about taking gas longer term and accepting. But essentially, that is the European position, and it's not a great one for getting priority over long-term Asian customers.
So, staying on the same theme, when Europe does emerge out of this crisis, what do you see as the long-term? Do you think there'll be any radical shifts in their energy policy, and if so, which direction do you think they'll go? Taking lessons from whatever is transpiring this year.
Well, we're already seeing radical shifts. There's a drive they've upped how much hydrogen they want to produce. There's a bigger embrace of renewables. There's a bigger emphasis on LNG. This Repower EU plan. How sustainable these things are is really how hard the economy is hitting. Is hit. That's how we're going to see the trajectory of it turn out, I feel. And if I was Putin, I would say I've still got, okay, things have not gone well, but I would still say I've got quite a lot to play for. And the price of gas and oil supplies is going to matter a lot in how this thing turns out. Ergo, I think he's using this lever. I mean, clearly you'd have thought, and the obvious thing, conclusion to reach is, okay, the energy transition has been slightly disrupted in that people need some hydrocarbons here and now in Europe, but longer term, they're going to embrace it harder and faster, which is probably means in the short to medium term, higher prices for oil and gas, and continued issues over investment. But long term is not good for certainly the producers. And
major damage to Europe's economy as well. I think that's
I mean, there's a reason why Germany took so much Russian gas. It was cheap. It made the economy competitive. We're going to see a long-term erosion in that, and I think people are going to wake up and go, "Oh, did we play this as well as we should have?" And that's going to hurt. At the end of the day, you look at Japan and what they've been doing with efficiency for decades now, and you can say, oh, well, you can have a successful economy with very high, almost total reliance on imports. But I don't think that those lessons are so easily applicable to Europe. I just don't see it. It's not a great place for the EU. And I suspect people are just beginning to wake up to this, and there's going to be lots of political ramifications. I don't see a united front to dealing with this.
Well, on that sobering note, thank you, Rafiq. Thank you so much, Mike and Robin, for joining us today. And have a great rest of the day, everyone.
We apologize.